All right, good evening, ladies and gentlemen. Welcome back to the Australian Gold Weekly Review. This is episode 8, and we are shooting this at 10 p.m. Sydney time on 27th September 2025. Welcome, everyone. If this is your first time watching, this is a series where we uncover moves in gold, silver, and other precious metals, as well as crude oil. And we also have a look at the movements within the precious metals and mining equities market in Australia in order to supercharge your investing journey and keep you as well informed as possible. We want to remind you that this series is a joint project between us and you, which means that if you have any form of feedback for us which can improve your viewing experience, please let us know and we'll be more than happy to implement them in the episodes to come. And the content that we discuss in this video does not qualify as financial advice. As usual, if you are on the outlook for financial advice, we recommend that you seek a licensed expert for the same. Before we move on, I'd like to let you know that this is a special episode as a part of this series because we're sort of breaking down the structure that we normally follow, and we're getting into something special, which is the fund performance of Gold Hub Australia and the Australian Gold Fund from January to September 2025. Now, brace yourself. The return of the Australian Gold Fund from January to September 2025 was 116.6% as of yesterday, versus the ASX Gold Index, which in itself has delivered an 86.8% return, which is an anomalous, outstanding return for any kind of index. And for the Australian Gold Fund to outperform even that benchmark by 30% is an incredible feat in itself. And we congratulate Mr. Brian, Trung, and Jimmy for managing the portfolio with skill and attention. There's a lot in it for you today as well. We're going to get into the portfolio. How has Mr. Brian, Trung, as well as Jimmy navigated the entire scenario from January to September 2025? What are the changes that they've made in their portfolio allocations? Who are they really focusing on right now? Is it the large producers? Is it gold in itself? Is it micro producers? Is it explorers, developers? We're going to be answering all these questions for you, and we cannot wait for you to get your hands on this video. So without any further ado, let's get started. And with gold, the usual, we've seen gold go up by 2.09% this week in the US, which is at US dollars 3,759 per ounce. And in Australia, it's broken all the records and gone on to Australian dollars 5,743 per ounce. Yes, 5,743 per ounce, which is a 2.85% increase as the US currency strengthened against the Australian dollar. Now, what exactly were the tailwinds for gold this week? Firstly, we've got the Fed policy repricing as the primary tailwind. We did see a 25 basis points cut from the Fed the prior week, which fueled expectations of further easing as investors are expecting rate cuts in October as well as December. And this dovish repricing was the backbone of the entire rally that began a week ago, which kept safe haven and macro hedging demand elevated as well. We also saw gold benefit from the dollar weakness this week. At the beginning of the week, a softer USD in the earlier sessions lowered the barrier for global gold buyers, which helped gold move towards the $3,790 region this last week before it slumped back to US dollars 3,759 per ounce. We also have seen strong investment flows that provided a cushioning to gold pricing, which is inflow into gold ETFs and funds, alongside elevated speculative long positions from investors and traders throughout the week, which was reinforced by a buy the dip mentality as well. But you know, the narrative for this week, in my opinion, is pretty much the same as the last week, where we saw gold had the potential to break out of a certain level. And in this case, in this week's case, it was the 3,790 US dollars per ounce region. But we did see a lot of selling pressure coming in as soon as gold reached the $3,790 region. And it came back to 3,759. And the reason behind that, we believe, is not only the fact that 3,790 is a resistance level for traders for gold, but at the same time, we've got the inflation data coming in from Fed yesterday, which was not it was quite a neutral signal in my opinion, which did increase the selling pressure and brought gold back down to 3,759. So, Mr. Brian, with rate cuts expected in October and December of 25 basis points each, as we said, what do you think the path ahead for gold is, especially at a time where Jerome Powell has mentioned that there has to be a balance between maintaining inflation as well as reducing the as well as reducing the jobless claims month on month. And I think those two things require two different policies, which is why the Fed is stuck in terms of implementing a policy that's sort of strong. And they're sort of testing the waters at the moment with these 25 basis points cuts. So in a time where it's essential to balance inflation and jobless claims, what do you think the path ahead for gold is as the Fed is testing the waters with minimal rate cuts?
Well, from what you've talked about, how gold has actually done really well in the past year and a half, I'd say. In fact, since the first announcement that there would be 3 rate cuts for 2024 in March till now, I don't think that the Federal Reserve has a very enviable job. I feel they're almost like the Greek mythology Atlas, the god, the Titan who actually had to hold up the sky on his shoulders, and he was relieved by I think it was Perseus who cut off Medusa's head, and Atlas actually wanted to see Medusa's head in order to turn him into stone to relieve him of his eternal torment in carrying the sky on his shoulders. I feel the Federal Reserve is pretty much in the same position. Now, with the addition of Steve Mirren into the Federal Open Market Committee, he's actually a bit of a maverick relative to at least the current Board of Governors, who have largely been hugging the shore and largely agreeing with each other on the decisions. Steve Mirren is actually saying, look, the economy is weaker. At least the economy does not need the Federal Reserve to continue to stand in the way for to help it recover, whether it's through President Trump's policy to use tariffs to increase manufacturing in the US, and also using foreign trade deals in order to break up the current what we call the unipolar hegemony central bank fiat currency system type of trading that is just holding up productivity and efficiency. I feel that with the removal of Lisa Cook, which should be imminent in the coming board meetings, I believe that there could be a potential for even higher or steeper rate cuts that could help fuel the general rally for the asset market, as well as, of course, gold and silver. Now, I know that there are some technical analysts who are saying that gold is quite overextended, and I tend to also agree with that from the at least the short-term horizon. We have seen gold rise from about, I think, 2,700 or so at the beginning of this year to almost 3,800. That is an increase of over 45% since the beginning of the year. We haven't seen that type of increase for probably since 2020, and if not, going back to, would have been 2011. All those times were during unprecedented economic crises, or at least there were major economic problems facing the world. So at this stage, I believe while I am bullish for the rest of the year, the risk of a sudden correction in gold and silver also exists, and that's why we have remained cautious during this time, just to make sure that we keep our gains, which we're going to talk about a bit later.
Right. Thank you for that, Mr. Brian. And indeed, we're going to talk about it later because we've seen a lot of changes in the portfolio allocation coming in ever since June 2025. In fact, in preparation for this video last night, I had pasted a table onto the script, and I woke up this morning and found out that the table in itself had changed within a day. We've seen so many percentage changes in the table. We've seen the top 5 holdings change. So a lot of proactive management going on over here in light of the recent economic events, changes in gold and silver prices, as well as the implications that's had on precious metals and mining equities. So stay tuned for that. And in order for that moment to arrive, we'll quickly just go through movements in silver, crude oil, and the ASX Ordinaries Gold Index as well. So silver, I believe, is the hero precious metal of this week because it's increased 7% to US dollars 46 and 5 cents, which is quite a humongous increase on a week-to-week basis for any kind of precious metal. And the reasoning behind that is that it's followed suit with gold this week. But given that silver has got industrial applications, along with being a safe haven metal, increases its volatility either ways when there's a price correction going on or if there's a rally going on at the moment. And that is a statement that I would like to make, but I'm not sure if Mr. Brian agrees with that statement or not. So let us know if you want to see a separate video on silver where we discuss the extent to which Mr. Brian agrees with how silver tends to outperform gold in bullish precious metals phases because of its precious plus industrials dual identity. And just as on a side note, we've seen signs of firming global manufacturing activity, including Chinese stimulus measures and US data stabilization, which supported the industrial side of silver's demand profile, which could have potentially also driven the 7% increase this week, given that this rally for silver would be more broad-based compared to gold's purely monetary or safe haven bid. Moving on to crude oil, it's increased this week by 4.45%. So between gold, silver, and crude oil, gold has seen the lowest increase this week, followed by crude oil and followed by silver. So crude oil's increased almost 5% this week to US dollar 65 and 18 cents. We've seen traders monitoring the OPEC plus discipline in terms of crude oil, and we've seen hints of tighter crude exports out of key producers. And the concerns around supply restraint contributed this week to WTI crude oil's bounce from 62.4 to the mid 63-64 range early in the week before it finally consolidated at 65 US dollars at the end of the week on Friday. And we've also got ongoing instability in energy producing regions, which is the Middle East and the North Africa, which helped keep a modest geopolitical premium embedded in the prices and cushioned the downside. And we've also seen signs of demand resilience, wherein US inventory draws midweek pointed to healthy refined product demand, while Chinese stimulus headlines reinforced hopes of stabilizing Asian consumption. And these demand signals provided credibility to the rally, where crude oil ended the week at $65 a barrel. On that note, the gold oil ratio has decreased this week, obviously as a result of the increase in oil prices overpowering gold. And the ratio is currently at 58.59 barrels per ounce, which is a decrease of 0.65 barrels an ounce. And now moving on to the ASX All Ordinaries Gold Index. I swear to you, when I calculated the change in the ASX All Ordinaries Gold Index this week, I actually ran the calculation 3 or 4 times on the calculator just to see if I'm getting the calculation right or not. Because we saw not even a 3-digit increase this week in the index, but a 4-digit increase in the index this week, 6 if you count the decimal places, which is 1,181.81 points, and the index is now at 15,500 points. So what exactly drove this rally? It's a fresh leg higher in the bullion, which lit the fuse for the ASX All Ordinaries Gold Index. We saw spot gold break to all-time highs, approach the $3,790 mark, which kept the 6-week uptrend intact and pulled gold equities along with it. And the ASX All Ordinaries Gold Index is obviously a reflection of all the equities that fall under the gold subsector in the ASX All Ordinaries Index, which in turn is an index tracking 500 biggest market cap companies in Australia. So if you see gold on a rally, and if you see the gold equities benefiting from it, there's a huge chance that you see a jump or a significant increase in the ASX All Ordinaries Gold Index, which is exactly what has happened over here. And in Aussie dollars, it was even better, because we saw that gold in Australian dollar terms increased this week much more than gold in the US dollar terms. And that is simply because the Australian dollar weakened against the US dollars, and this makes investors a lot more bullish on the margins for Australian producers whose costs are in AUD, which is the case for most of the producers and explorers listed on the ASX, which also does contribute to the rally. And heavyweight leaders, they tore up the charts this week. Early in the week, the ASX's top 10 gainers in the ASX 200 were gold miners, and that rally was led by Genesis Minerals. And I think this was on, I believe, the 22nd or the 23rd of September at about 11 a.m. Australian Eastern Standard Time, when 9 out of 10 gold producers, 9 out of 10 listed equities on the ASX 200 were gold producers when it came to the top gainers of the day. So across the larger caps, we've seen a lot of good news. You talk about Regis Resources, Northern Star, you talk about Evolution Mining, you talk about Perseus Mining. We've seen all these equities enjoy a lot of gains this week, which has contributed to the index as well. In terms of the top 10 biggest risers, we've seen Yandal Resources Limited increase by 100%. Terra Metals increased by 60.87% after their announcement of a 58-meter thick reef that they intersected at their polymetallic deposit project. We've seen Dateline Resources Limited that's been making the news as well, Savannah Goldfields Limited, Barton Gold Holdings, and many more explorers and developers as part of that list. And pretty much the same for top 10 biggest decliners as well, but the declines were far more modest than the increases in itself. We've seen declines go between 9% to 27%. And as far as the large producers are concerned, Northern Star stayed in the headlines and bid higher before a big block crossed. We've seen sentiment around Northern Star improve as gold set records, and then Goldfields moved to sell its 1.1 billion Australian dollars stake via an underwritten block as its takeover of Gold Road closed. And that created a large, well-absorbed liquidity event rather than a drawn-out overhang. And we've seen sector mergers and acquisitions activity provide a tailwind as well. Goldfields' scheme for Gold Road Resources reached court approval and became effective by week end, which added another marquee transaction on top of recent consolidation. Obviously, we're all aware about the fact that Gold Road Resources will soon be delisted from the ASX as it gets acquired by Goldfields Limited, and that has added to the marquee transactions of Northern Star acquiring De Grey Mining and Ramelius Resources acquiring Spartan Resources. So this steady drumbeat of deals reinforced the market's view that Tier 1 ounces are being bid up, and it supported multiples for listed producers and near-level producers. And just one more point to make, ladies and gentlemen, before we dive into the portfolio, is company-level catalysts kept the momentum warm this week as well, because we've seen Ramelius Resources continue to feature in news flow around the Spartan integration, as we just mentioned, and substantial holder notices throughout the week that increased trading activity, while prior updates flagged progress at their Dalgaranga or Never Never and Pepper mining with a pre-feasibility study due this December, which is useful narrative fuel when gold is breaking out. So I think this is, the reason why large equities such as Ramelius have also rallied this week along with gold. And more than gold, is because we've seen corporate activity in terms of these companies come along and support the prices as well. It's pretty similar to explorers increasing in prices when any form of narrative or announcement comes out on the ASX, which does contribute to the increase in gold prices. So that would be it, ladies and gentlemen. That is pretty much the scenario for gold, silver, crude oil, the gold oil ratio, and ASX All Ordinaries Gold Index this week. Now, let's discuss the implications of these drivers that are driving precious metals prices, that are driving the index, and how we're using these drivers at Gold Hub Australia and the Australian Gold Fund to invest safely and at the same time outperform or outsmart the gold indexes, who in itself have delivered, I would say, unprecedented returns, because it's definitely not normal to expect an index to deliver an 86% return to you within a span of 8 months. And to outperform that by 30% is, as I said at the beginning of the video, a big deal in itself. So let me give you a brief overview into the portfolio of the Australian Gold Fund, and then Mr. Brian can take it over from there. So if you notice, the Australian Gold Fund has increased their holdings in cash quite a lot compared to June 2025. I think they had negligible holdings in terms of cash in June 2025, where I think it was in the 0.5 to 1% range. And now they've increased that to 5.5%. And at the same time, they've taken off their holdings in major and large producers by about 3%, where they have nearly no holdings in major and large producers in terms of market value. So 0.5% of the portfolio value comes from major and large producers, which is pretty negligible considering the fact that mid-tier producers are 25.3% of the portfolio in terms of market value. Junior and micro producers are 13.7%, and developers and explorers are 50.3%. So half the portfolio is developers and explorers. And that, to some of our viewers, would be quite contrary to what we've been discussing, because we rarely do bring up a developer or explorer into our company level analysis discussion. Or we don't, every time we discuss the index, we talk about the moves in gold, the moves in silver, as well as crude oil and the gold oil ratio, and the macroeconomic environment on these large cap companies, or at least mid cap companies that come under the 500 biggest companies by market cap in the All Ordinaries Index. So the fact that the Australian Gold Fund holds 50.3% in developers and explorers, which are not these big producers or these mid-tier producers, may come across as surprising for some of our viewers. And we'll break down exactly why the fund has decided to make that move in recent times. And of course, precious metals and tech ETFs is a 5.1% holding in the portfolio in terms of market value. So the fund is also doing its bit to increase inflows into ETFs, which in turn increases gold prices. So I think we are playing our role in increasing gold prices and contributing to the rally, apart from obviously posting these videos, because they in itself do increase gold prices quite often. So yes, Mr. Brian, the first question that I would have for you in terms of the portfolio is, explain the rationale behind parking the majority of the funds among developers, explorers, and junior producers. And the reason why we ask this question is that developers and explorers arguably offer an unparalleled upside compared to producers, in my opinion, as these stocks are highly speculative in nature. Because if you look at the top 10 risers of the week, pick any week in the year and have a look at the top 10 risers, you'll see that most of them are developers and explorers, and very rarely would be the case where a large or a mid-tier producer has been the top riser for the week, or has been in the top 10 risers for the week. So as much as the upside that these stocks offer for the week, they also come with the risk of making losses if the company fails in its exploration pursuits. Because at the end of the day, it is these announcements in relation to the exploration that contribute to the upside or the downside of the stock. So talk about how you've decided to contribute 50% of the fund's value to these developers and explorers, and how you navigate this risk to reduce the possibility of incurring losses on explorers. In other words, that would mean, what are the de-risking factors that you look for in explorers to ensure that 50% of your holdings are quite safe?
Okay, so firstly, I want to say that in terms of the Australian Gold Fund portfolio, it's not just really the effort of myself along with my partners, Jimmy and Trung, but it's also people like yourself and also the finance and data analytics team who help maintain the database that we have on the gold producers. Also with the speculative gold stocks, the explorers and developers, we also collect data on that. We also collect quite a lot of data on the precious metals market. We created our own gold stocks valuation index in order to gauge the relative valuation of the ASX Gold Index, along with the factors that we believe drive the value of producers, which are gold and the gold to oil ratio. Back 2 to 3 years ago, when I was actually running this myself, just with the help of Trung looking after the data, we didn't have a big business. I spent quite a lot of time also checking the data and all that, so I'm very familiar with the market. How did I become more speculative? How did I get the portfolio to become more speculative? It actually goes back to 2021 when I joined Factor Investment Research and wrote the newsletters for them. In one of the newsletters is the Australian Gold Report, which focuses on the more established producers and developers and helping people to build a precious metals portfolio. The other newsletter is Gold Stock Pro. It is a speculative newsletter that focuses on guiding readers to purchase early stage companies, whether they're explorers or developers that have found the deposit and are in the process of securing funding and creating a mine plan to bring that to production. Now, why did it take me to work at Factor Investment Research to go and move into these more speculative stocks? Is that if people go back to the goldfund.com.au website, which is my Australian Gold Fund website that I created back in 2019, I started off as a investor in producers, and I stayed away from the developers and explorers to the best of my ability, unless we were deep in a bull market and I may have gotten carried away with the sentiment. But that changed when I started having to write the newsletter at Factor Investment Research, and I had to be much more familiar with those companies that I inherited from my predecessor, and also had to recommend new ones myself to my readers. So as the bull market of 2020 faded and turned into a bear market in 2022, 2023, I realized that I started to like some of these explorers and early stage developers, quite a few of these, because they owned a deposit that I thought was pretty solid. They had existing infrastructure that they could potentially develop and bring to production. So having seen in 2020 and early 2021, a lot of these producers starting to come off the boil, I thought that because of the pandemic, because of the lockdown, because of all the stimulus, that inflation is going to push gold back up and the value is going to be in the smaller end of town. So that's why I started shifting my portfolio, and you will see on this on the display the historic stock allocation of our portfolio across producers, developers, and explorers. You will see that increasingly my exposure to these more speculative companies increased significantly. I was buying into what I thought was value. I got trapped by the bear market, and rather than selling, so I don't believe in stop losses in a very volatile space. This is something which I differ from a lot of traders. I don't do stop losses. It actually helps me in the recovery. It also does hold my portfolio down a bit when we have an extended bear market. And furthermore, I do sometimes get caught by companies that do really badly and end up failing. I have had in my portfolio the last 2.5 years, held companies that have actually gone broke. Yandal Resources is one of them. And I do hold some companies that are very, very heavily hit compared to what it was in the last bull market. But I ride the recovery if I see the quality assets. And that is why we expose ourselves quite heavily on these, on the early stage of the mining life cycle, because a lot of the large producers, as you have heard in our past weekly commentary, and also on AUSBs, I believe a lot of these producers are very much generously priced in, if not already overvalued. I'm looking for value in the smaller end of town. There are several companies that have taken off. If you look at companies like Barton Gold Holdings, Black Cat Syndicate, Mika Gold, or Mika Metals, Strickland Metals, Southern Cross Gold, Consolidated, all these companies have taken off, and we have held these companies through the highs and the lows and accumulated as they were low, and now we're seeing substantial profit. And as the gold market continues to rise further, and these stocks as these stocks continue to rally, we're going to be able to sell some of these and reduce our exposure in order to de-risk our portfolio as you're looking for. Very detailed answer, but I thought I needed to give you guys the backstory first in order to understand how we actually got here. It wasn't a sudden process of, there's a bull market, we're just going to jump on these companies. We actually held some of these companies in the bear market.
Right. Thank you so much for that, Mr. Brian. I think the audience would appreciate the level of detail that you've pursued in answering this question, because as you said, as rewarding as these developers and explorers could be in terms of the returns, they could be equally risky because of their speculative nature. And I think it's wonderful that you've thoroughly explained the reason behind why the fund invests in developers and explorers on a majority basis, and how you actually transitioned to that belief from initially starting by investing in producers in 2021. So thank you so much for that. Now, we've seen that compared to June 2025, the fund is holding a lot more cash, a 4.5% increase. It was about 0.5% in June 2025, and it's 5% now. So what would you attribute that to?
So I was actually just going through the cash allocation, my portfolio allocation table, and I forgot to unmute myself. So why have I increased my cash position? I'll give a bit of context on this as well. If you look at the portfolio allocation for the Australian Gold Fund, the last time I had a more substantial cash position was exactly 4 years ago at the end of the September quarter 2021, when we held about 20% cash for the first time. We almost always are close to fully invested in gold stocks, because I personally don't like the idea of holding too much cash, especially because it is an asset that's, I wouldn't even call it an asset. It's something that they've been creating at infinite rate. So it's declining in value slowly but surely. So I like to be exposed to something that gives me more return, and also protects my purchasing power. It's either precious metals or gold stocks or some other stocks. But in the Australian Gold Fund, I hold only gold or precious metals related assets. Now, why did I increase the exposure? Is, as I've said before in several of my videos, I believe that a lot of these gold stocks are starting to become quite generously valued. And even as I take profits from these established producers and developers, I don't want to make the mistake that I have made in the previous bull markets in 2016, in 2020, where I took the profits from my gold producers and shoved back quite a bit of them into the companies that were starting to rise, but they were lower quality companies. I did buy quite a bit of physical bullion and also set aside quite a bit into my savings back in the past bull markets. But this time around, I thought it would be better for me to hold some cash, given also gold and silver seem to have been quite overstretched as well technically. That's why I'm holding some cash in order to give me the opportunity to potentially buy into any correction that may come about because of how all the precious metals assets are looking a little overstretched, at least the bullion, the metals themselves, the larger companies, and now increasingly some of the smaller ones.
Right. And just like we've seen the cash position of the fund increase significantly, we've also seen the allocation to large companies decrease. Now, I think you've provided enough information for the viewers to intuitively gauge why you must have decreased your positioning in large companies by such a significant amount. But if you could dive a little bit more into the drivers behind reducing the fund's holdings in major and large producers to nearly 0% from over 3% in June 2025. And once you answer that question, we'll move on to a question in conjunction to that.
Okay, so there aren't too many major and large producers on the ASX. They're namely Newmont, Northern Star, and Evolution Mining. So I at one stage, and also Perseus Mining. At one stage, SSR Mining and Regis Resources were also part of that, but because SSR Mining delisted at the end of the June quarter, and Regis Resources, their production is below 500,000 ounces, so they became mid-tiers. With the major and large producers, we had been holding Northern Star, Evolution Mining, and also Perseus Mining. I reduced my holding on all of them as their market cap rose significantly. Northern Star, even though it's a great company, but I guess I've seen how they've grown to a stage where further they bought De Grey Mining, and they're going to likely produce out of Hemi, I'll say 2028 by the earliest. They're currently in a position of consolidating and increasing efficiency of their existing mines. I have been wrong about Northern Star, and I don't mind being wrong about my underweight position on them. I have actually seen more efficiently run smaller companies that I would like to. I like to ride those because they got a higher beta or sensitivity to the price of gold. Now, with Evolution Mining, it has become a $20 billion company. And to think that 3 years ago to this day, 27th of September, the market cap was about $3.5 billion. The company hasn't grown its production during these 3 years. Rather, it was swapping its portfolio, its assets. It sold down. I think it sold its. It sold the mine. Not Krakow. Krakow they sold to Ordinaries Resources. They sold Mount Carlton to Navarre Minerals, which then didn't work out. Mount Rawdon is going out of it's going to go into care and maintenance, where while they've been expanding, Powell, Mungari, and Red Lake complex is finally getting into they finally sorted that one out. They bought North Parks, but I just think $20 billion is probably too much of a stretch for me at the moment. I'm sure I can come back later on when gold comes off the boil and buy Evolution Mining at a better price. Same with Perseus Mining. Perseus Mining production is going to fall back below 500,000 ounces in the coming year as Edikan slowly depletes. And I think Sissingu is also the same. And they're bringing Nyangaza from Tanzania. I think that begins production in 2027. So right now, all these companies, they are a bit overstretched, and that's why I've reduced my exposure to them. Doesn't mean that they're bad companies. It just I just think I would prefer to protect my capital rather than chase it even higher.
Right. Thank you so much for that. And in conjunction to that, we've seen your top 5 holdings being Ordinaries Resources, Cavalier Resources, Black Cat Syndicate, Alken Resources. And the last one is the one that I've got a question about, Ramelius Resources. Now, if you have a look at Ordinaries Resources, Cavalier, and then have a look at Black Cat Syndicate and Alken Resources, I would position Cavalier Resources as a developer, obviously. I think they have produced, I believe, between 25 to 27,000 ounces of gold, or at least shown proof of production from their probable and proven ore reserves. But if you have a look at Black Cat Syndicate and Alken Resources as well, obviously not at the scale of Ramelius Resources. Now, I know that Ramelius Resources is not a large producer, but in comparison to Warida or Cavalier Resources, Black Cat Syndicate and Alken Resources, Ramelius is quite high up there in terms of its production and I would say stock price as well. So explain your rationale behind having Ramelius Resources on there as a part of your top five holdings.
Okay, so Ramelius Resources is probably one of my favorite producers. I first bought them 12 years ago when they were, I think the market cap was about $35 million, and they were trading at that time. The first time I bought them, I think they were about 20 cents or so in July or August 2013. And they dropped to as low as about 4 cents in November or December 2014. Why did I like them? At that time, they were producing about 100,000 ounces of gold. Gold was trading at about $1,350 an ounce, Australian, by the way. And they were a very marginal producer. I think their all-in sustaining cost at the time was about $1,100. They were actually struggling to break even when gold came down. Ramelius Resources made me, I think I bought about $35,000 worth of Ramelius Resources shares between 2013 to 2014. And by 2016, when they had come back up to about as high as 62 cents in mid-2016, and I took some profits, I actually didn't sell everything, $35,000 became $100,000 throughout that time. So I like that company quite a lot. It was there were 3 companies that I made 6-digit gains in the first 2.5 years of me trading in gold stocks. They were St. Barbara Mines, Resolute Mining, and Ramelius Resources. Now, Resolute Mining and St. Barbara Mines, they've had a very rocky ride. If you guys can see the share price charts on display. And furthermore, their growth, their production growth, they actually have stagnated, if not gone backwards. In the case of St. Barbara Mines, they've actually gone backwards quite drastically, in fact. I was glad I actually gradually sold those down after they bought Atlantic Gold in 2019. Ramelius Resources, meanwhile, actually grew organically and also through acquisitions. Actually, no, sorry, they grew through very smart acquisitions. They by 2018 they bought Edna May from Evolution Mining. They had bought Kathleen Valley and Vivian in 2014. Then they started producing out of that. Then they bought Edna May in 2018, Spectrum Metals, Spectrum Minerals in 2019, I think it was. Then they also purchased, what else did they purchase? They purchased Mother and Tampere in 2017 and 2018. Then it was Apollo Consolidated in 2021. In 2022, they purchased, in 2023, they purchased Breaker Resources. And they grew their production gradually from 100,000 ounces in 2013 to about 200,000 ounces by 2018. And as they were replacing some of their depleted mines with small mines, they were growing their cash reserves. And this year they merged with Spartan Resources. The company propelled from a $30 million company 12 years ago to a $7 billion company now. It's an amazing journey. And I liked Spartan Resources in early 2023. I was one of those few people that luckily didn't buy into the Gascoyne Resources story, which was a bit of the disaster. But the disaster actually, out of the dying embers, created this huge potential to become a real cracker of a company. Of course, thanks to Simon Lawson and his team, who found the Never Never deposit underneath the Dalgaranga mill, and they also found the Peppers deposit. So I held a pretty large stake in both Ramelius Resources and Spartan Resources from 2023 onwards, and started taking profits as of early last year as gold started taking off. I would have actually had an even bigger holding if not for the fact that I decided to take some profits during this gold bull market. I still retain quite a large holding relative to my portfolio, and that's why it still is in the top 5 holdings, despite the other 4 companies being much smaller in terms of its market cap.
Right. Thank you so much for that response, Mr. Brian. I think the viewers have got a good understanding of where the portfolio stands to date in terms of its allocation. And despite shying away, I would not say shying away is the right word, but despite, I would say staying away from the big names at the moment, like Evolution Mining, Perseus Mining, etc., why you still made the decision to continue your investments in Ramelius Resources, despite the fact that I think Ramelius Resources would be a part of that list of the big names in the mining industry at the moment in terms of their stock price performance. On another note, I also think the viewers have got a pretty good understanding of the reason why the fund is so bullish on developers and explorers, and the strategies that you look to de-risk your own investments in the fund. So thank you so much for that, Mr. Brian. I think the viewers have got a lot to take away from today, and we'd like to remind you all that none of the content that we've discussed in this video qualifies as financial advice, though we do wish that you make returns as much as the Australian Gold Fund has made in your own investing journey. So that's it, ladies and gentlemen, from our end. Thank you so much for watching. If you have any feedback, please put it up in the comments below. We were really pleased to have a look at the reception in our last episode, and we hope that it continues to be the case with this episode as well. So thank you so much for watching, and we'll see you next time.
Yep, that's it, and hope you enjoy it. Please make sure you like and subscribe, and everyone, thank you and God bless.